Did you know that right now, there is a fundamentally explosive healthcare company sitting on a coiled spring of over 61 million trapped short shares? Welcome back, investors. Today, we are looking at a setup so incredibly pressurized that recent market panic may have handed us one of the most talked about buying opportunities of the year. We are talking about HIMS and HERS Health, and the big question on everyone's mind is simple. Is HIMS about to stage a massive comeback? What you are looking at here is a stock that has been artificially compressed by a series of chaotic, unforeseen black swan events over the last few weeks. But if we look past the terrifying headlines and dig into the raw data, this compressed spring could be gearing up for something the market simply isn't expecting. Before we dive into the chaos, if this kind of deep dive analysis is what you're here for, do me a quick favor and smash that like button and subscribe. It genuinely helps the channel more than you know. Now, to understand how we got this massive discount, we first have to look at the exact timeline of the chaos. Recent black swan events have temporarily and brutally compressed the HIMS valuation. And here's the fascinating part. This aggressive downward deviation may be completely masking a heavily intact underlying bullish thesis. We are currently looking at a massive short interest situation layered directly over expanding business fundamentals. In the short term, the compression is severe, leaving an astronomical amount of short interest potentially vulnerable to immediate catalysts. Meanwhile, the long-term momentum appears to be backed by an untapped multi-billion-dollar market and a massive global acquisition. But here's what makes this so intriguing. While these growth numbers look incredible on the surface, there is one hidden metric we'll look at in a moment that could change the entire picture. So how exactly did the stock fall from its technical setup into this deep value territory? Let's walk through the deviation. If you were trading this in mid-July, you saw the initial setup between $35.20 and $35.50. However, on July 16th, a critical stop loss was triggered when the stock closed at $33.68, instantly invalidating the immediate technical flag structure. Then came July 23rd, the FDA catalyst. An FDA advisory panel actually backed 6 out of 7 key peptides, pushing the stock up to an intraday high of $35.85. But investors realized the formal rulemaking process could take a year, triggering a massive sell the news pullback. Then, just days later, on July 29th, the ultimate black swan hit. An unforeseen FTC lawsuit regarding data privacy practices caused a sudden 12 to 13% gap down, plunging the price to $25. But now watch the end of the timeline on July 30th. Buyers immediately intervened, recovering the stock by 8% to a $27.04 close. And that begs the question, why would buyers rush back in so aggressively, so fast? This timeline tells a compelling story, but if we separate the sensational headlines from the actual business metrics, the answer starts to emerge. We have to ruthlessly divide the noise from the signal. The noise right now is almost entirely regulatory friction. You have an FTC privacy lawsuit and FDA formal rulemaking delays creating panic. That explains the sudden 12 to 13% gap down in price action. But the signal? The signal is what the business is actually doing behind the scenes. The core economics reveal a staggering 73% gross margin profile and 2.58 million active subscribers as of the first quarter. Furthermore, the market positioning shows HIMS holds a strong first-mover advantage in branded GLP-1 weight loss and compounded peptides. So here's the key takeaway, and it's a big one. These recent regulatory hurdles may not represent a failing business at all. They may simply represent a rare discount on a hyper-growth healthcare leader. Now remember that short interest I mentioned earlier? Let's look at the actual trap that short sellers may have walked themselves into. This is the powder keg. As of late July, short interest remains astronomically high at 31.82% of the float. That equates to over 61.1 million shares sold short. Now here is why that matters. Based on average trading volume, it could take short sellers a grueling 3.2 days just to cover their positions. And here's the contextual insight that's crucial for our thesis. Despite the massive price drop in July, the short sellers have not exited their positions. Could it be that they are getting greedy? Because they haven't covered, the powder keg we identified weeks ago appears to remain entirely intact and highly pressurized. But a powder keg needs a match, so what would it actually take for this thing to go off? Here is the mechanical sequence of how a short squeeze could potentially detonate. A short squeeze isn't magic. It is a forced mechanical reaction in the market. Step 1 is the spark. This would come from a fundamental catalyst, like an earnings beat or management reporting low subscriber churn. Step 2 is the institutional reaction. As the price ticks up, options dealers can be forced to hedge their positions, meaning they may have to buy the underlying stock to cover their call exposure. Step 3 is where the trap could snap. Those 61.1 million short shares would suddenly face immediate, potentially unlimited upside risk, forcing panic buying. And finally, step 4 is the release. This compounding buy pressure could violently drive the stock back toward the heavy options call walls sitting in the mid-30s. So when exactly could this sequence begin? Well, here's the exciting part. We may not have to wait long at all. The potential ignition point for this entire setup is locked in for August 10th, 2026. This is the second quarter earnings report, and expectations on Wall Street are already explosive. Analysts are forecasting a massive 20% sequential jump in revenue, targeting $730,012,000. Even more importantly, they are projecting a definitive swing into positive profitability with an adjusted earnings per share of 11 cents. Now imagine this. If management delivers strong forward guidance on their GLP-1 subscriptions and their recent global acquisitions, could it provide the exact fundamental buying pressure needed to trigger that mechanical short-covering rally we just broke down? It's certainly a scenario worth watching closely, but earnings are just the short-term catalyst. If we dig deeper into the actual products, the underlying moat appears to be getting wider. Let's revisit that FDA catalyst because the market may have largely misunderstood it. The FDA advisory panel officially voted in favor of adding 6 out of 7 key peptides to the compounding list, including the highly popular compound BPC 157. This is a significant regulatory win. But here is where the competitive moat comes in. HIMS and HERS actively owns a dedicated peptide manufacturing facility right in California, and this could give them an incredible strategic advantage. They may be perfectly positioned to completely bypass third-party supply chain bottlenecks and move quickly to dominate this newly regulated space the second final approval hits. So what is all this actually worth in pure dollars and cents? Let's run the math on the peptide market. According to estimates from Leerink Partners, full FDA approval could unlock an incredibly lucrative, high-margin revenue stream. They project the annual telehealth peptide market could explode to a $2.2 billion total addressable market. Given the HIMS first-mover advantage and their in-house manufacturing, analysts project they could reasonably capture about 20% of this market share. And what would that translate to? A staggering $440 million in entirely new potential revenue. This wouldn't just be an incremental bump. This could be a fundamental expansion of their entire business model. But that's only half the story, because while they work to conquer the US market, they have quietly executed a massive international takeover. HIMS has officially gone global. They recently closed a monumental $1.15 billion buyout of the Australian digital health platform Eucalyptus. And crucially, they closed this deal a full month ahead of schedule. This rapid acquisition instantly expands the company's operational footprint beyond the US, branching directly into Australia, Japan, Canada, Germany, and the United Kingdom. So what does this accelerated timeline actually mean for us? It could mean that international revenue realization hits the balance sheet well ahead of previous Wall Street models, potentially providing yet another catalyst for unexpected earnings beats. And as they scale globally, they appear to be solving the single biggest problem in all of telehealth: customer retention. You've heard me call them the Netflix of healthcare, and this is exactly why. HIMS is deeply integrating artificial intelligence into their ecosystem, specifically through a feature called Labs AI. This capability delivers highly personalized, data-driven health insights to individual users based on their unique biomarkers, and the impact of this cannot be overstated. It could fundamentally transition the platform from a one-off, transactional telehealth service into a highly sticky, predictive subscription ecosystem. So what's the financial result? It may drastically lower customer churn. And in the subscription business, low churn is the holy grail for both short-term earnings beats and long-term valuation multiples. When you stack the margins, the subscribers, and the ecosystem together, you start to get a very clear picture of where this company might be headed. Let's look at the foundational pillars management appears to be building upon for the end of the decade. First, you have that elite 73% gross margin profile. Margins this high demonstrate immense premium pricing power and operational leverage. These are software company margins on a healthcare product. Second, they have an escalating recurring revenue base of 2.58 million active subscribers, giving them highly predictable cash flows. And finally, this entire foundation is aggressively driving toward management's long-term finish line, a target revenue of $6.5 billion by the year 2030. But here's the real question. None of this matters if the big players aren't putting their money where their mouth is. So who is actually buying this dip? Smart money appears to be stepping in with real conviction. Institutional giant BlackRock recently revealed they have increased their total stake in the company to a massive 11.9%, holding over 26.49 million shares. Now think about what that signals. This level of institutional accumulation suggests that the recent price drop to the $25 to $27 range may be viewed by the whales as a severe market mispricing, not a fair value recalibration. And Wall Street analysts seem to agree, maintaining robust price targets that imply significant upside. Bank of America sits at $37, Barclays at $39, and Canaccord Genuity is holding a $40 price target. But if we look at objective value models rather than just 12-month analyst targets, the final valuation is honestly staggering. This is the big payoff. Based on advanced value models tracked by Simply Wall Street, which account for projected future cash flows mapped against the company's incredibly large total addressable market, the stock's long-term fair value can be modeled as high as $173 per share. Just let that sink in for a second. Compared to its current trading levels around $27, some models suggest HIMS could be as much as 80.5% undervalued today. Now, that is an aggressive model, and the future is never guaranteed. But this data clearly illustrates the massive gap between the current fear-driven market pricing and the underlying mathematical potential of their business model. So how do we play this? Whether you are trading the short term or investing for the long haul, here is a potential playbook to consider. Before I give you the breakdown, I want to be completely clear with you. I am not a financial advisor, and nothing in this video is financial advice. Everything you've heard today is for educational and entertainment purposes only. The stock market carries real risk, and you can lose money, so please do your own research and consider speaking with a licensed professional before making any investment decisions. With that said, let's talk strategy. For the short-term tactical traders, one approach some may consider is watching that immediate dip. That rapid 8% recovery we saw on July 30th could suggest a floor of support is forming. The key trigger to watch is the August 10th earnings report. With 31% short interest, any significant positive surprise could theoretically target a short covering rally, pushing back toward those options call walls in the mid-30s. And for the long-term fundamental investors, the thesis appears far more structural. A first-mover advantage in GLP-1s and peptides, backed by a 73% margin profile, all aimed at that 2030 milestone of $6.5 billion in revenue. Because at the end of the day, HIMS isn't just selling prescriptions. They may be building one of the most sustainable healthcare platforms of the decade. So now I want to hear from you. Here's my question. If HIMS does beat earnings on August 10th, do you think this short squeeze actually plays out, or do you believe the regulatory overhang keeps a lid on the stock through the rest of the year? Drop your honest prediction in the comments below. I read every single one, and I genuinely love the debate. And if this breakdown brought you real value today, please take 1 second to hit that like button and subscribe so you never miss the next deep dive. I'll see you in the next video.